But let's bring in another perspective on today's sell-off. That is Peter Yastrow. He's standing by the Chicago Mercantile Exchange. He's a market strategist and principal at Yastrow Origer. And Peter is a frequent guest here on Bloomberg Fast Forward. So, Peter, you called a double dip recession a while ago. It seems like both the equity markets and the credit markets are finally catching up to you. I was reading an interesting look at high-yield debt spreads right now, indicating a 48% chance of a double-dip recession. Just a few weeks ago, I guess those same spreads were indicating maybe a 12% chance of a double-dip recession, much lower.
Yeah, it's pretty clear that growth, not only in this country, but globally, is really slowing. Reasons for that start to get pretty big, pretty fast. And I hate to get into a profound discussion of global growth rates and the Industrial Revolution, but the bottom line is that we really have an economy, a global economy, that's slow. And now we're all fighting over the same turf. So as you see the competition, and you saw Asia cut their rates a week ago, and everyone started cheering that the dollar is gaining strength, what they were really doing was starting the race to the bottom here, because everybody's going to have to sell basically the same tools, the cars, the phones, the computers to each other. And whoever's got the cheapest currency, maybe will stay in business the longest here.
Peter, I got to get your perspective on what is moving the market in such drastic swings. We had such a big upswing about half an hour after the Fed statement yesterday. And, of course, right at the open today, we see a rush to sell. I mean, what's really driving market movements right now? Is it headline risk? Is it real fundamental issues or structural issues in Europe? Is it fears over the U.S. economy, or what's happening in Asia?
Well, I would think of it this way. There's huge piles of money, enormous sums of money that need to be invested. We start looking at all the investment opportunities out there. We look at Europe, we look at emerging markets, we look at U.S. debt, we look at equities, and we start to discard what looks scary. So we discard the bonds because of fear of inflation with the Fed printing money. You discard stocks because of fear of you end up with nothing left in your arsenal here. And that's really what's happening. People are scared. They're not sure where to put the money. When the fear gauge erupted on the S&P downgrade, that was just fear, because you saw them fly into treasuries and come back, flocking back to the United States, where we're considered to be the safe haven. Now you have Europe in a major problem. And we really should think about this for a minute in the context of how big it is. We were up in arms in this country because all of our congressmen and the president, the White House, they were having trouble coming to an agreement, and they're all on the same team.
Hey, Peter, you're echoing a sentiment that we hear down on the New York Stock Exchange. People are angry there's no solution, and you're seeing that translate as they go into safety.
You're interrupting me. I'm sorry.
Let's hear it.
I'm sorry, you're interrupting me. But the point is that in Europe now, they have Portugal, Ireland, Italy, Greece, Spain, Germany, France. These are not the same team. These are not the same country. These are different countries, different populations, different experiences. Some of these countries hate each other and have for a couple of generations now. So the prospect of trying to fix the European Union and resolve the crisis that they have, which is very similar to the one we face in the United States, is almost an impossible task. So what we're doing now is we're all holding our breath, and we're watching to see what happens out of the European Union. The banks in this country have a lot of exposure there. There's tremendous exposure to France. France is the next ship that's about to start taking on water, so I suggest you keep your eyes on France credit spreads. But this is really scary because we're talking about systemic failure. We're not talking about Economics 101 here. We're talking about macro systems.
I'm going to interrupt you, Peter, okay? What are you doing as a trader? You sound scared to death. What are you doing about it?
I'm still pretty clear that I buy U.S. corporations, multinationals that pay dividends. I'll take the dividend yield. I continue to do that. If the dollar weakens, then these companies tend to do better because they're able to take advantage of the weaker currency as they repatriate the funds. These companies are designed, they're huge capital-intensive machines, and now that the Fed, in their desire to help the banks, is going to be giving everyone free money until 2013, these large multinational corporations are going to do quite well on that. I'll take the dividend yield and run. And if I want to get even fancier, I can do some collars. You sell calls, buy puts to protect yourself, but I don't want to get into advanced strategies here. But But it's pretty obvious that U.S. equities become a great place to put your money, and I'm actually a buyer today.
All right, Peter, always appreciate the insight. And hey, we like those advanced strategies, by the by. Thanks so much, Peter. Peter Yastrow coming to us, market strategist at Principal, at Yastrow Origer.